Welcome to Dad Gives Advice. My name is Orestes, and in this video I want to cover a brand new set of topics around investment vehicles or securities, things that you invest money in the hopes of getting a return that is higher than what you invested in. And we'll start that series topic simply with stocks. Before I begin, remember that these videos are for educational purposes only, and anything that I say should not be taken as individual advice to you, the viewer. It should only be taken in as general purpose information, general purpose educational information. You should consult your own personal financial advisor before you take any action. And this video does not in any way say that you should go out and invest in individual stocks, especially if you know very little about investing. The whole purpose here is for me to impart that information that I wish I had learned a long time ago, which is, in this case, what are stocks and what they're all about and how they work. Okay, so let's get started. There are several types of stock, but the most common ones are common stock and preferred stock. I'm not going to go into preferred stock because I don't want to make this too long. Let's just start with common stock, which is when you hear people talking about stock in publicly traded companies, they're typically talking about common stock. So simply put, common stock shareholders own a fractional share or fractional percentage of a company that is trading stocks. Now, a stock could be issued by a company that is still private. In other words, the company is not being traded on a market. We won't cover those in too much detail, but it is possible for private companies to be issuing stock to their own internal shareholders, and most of those would be family members that are involved with running the company, or even employees of the company and a board of directors of a particular private company. So it's possible that they could be shareholders of a private corporation in that sense. And it's also possible that if that private corporation decides to come public, to make what's called an initial public offering, that those same shares that those private holders had turn into common stock shares as they issue new shares for the public to buy. But for the rest of this video, we'll talk mostly about publicly traded companies that have made their initial public offering or IPO and are now trading on one of the open stock markets that are available around the world. When you buy a share of a company in the form of 1 share, 100 shares, or 1,000 shares of their stock, you own a small portion of that company. Now, companies out there that are in the public domain that are being traded publicly typically have millions or hundreds of millions of shares outstanding. So even if you own like 1,000 or 5,000 shares or even 10,000 shares, you're still a very small percentage owner in that particular company, but you are an owner. Shareholders of a company are called limited risk owners because they don't participate in the day-to-day operations of a particular company, and therefore they do not participate in any kind of lawsuits. They don't have any liability if any lawsuits or judgments are brought against those particular companies. And their risk is limited to the amount that you invest in the company. So if you invest $1,000, $10,000, $1 million in a particular company, that's as much as your risk is in that company. Hopefully, obviously, when you invest, the stock price goes up and you profit from that. But if the stock price happens to go down, or if the company ends up in bankruptcy and loses everything, you might lose the entire amount of money that you invested in that particular company. So that's where your liability or your risk is when you're a shareholder of a particular company. The way that a stock is created is a company has a board of directors, and the board of directors decides how many shares to initially issue when they're first deciding we're going to issue shares of stock in this particular company. And they may also at certain points in the future decide to issue more shares if they want to try to grow the company by going out to the market, out to the stock market, and raise more capital. So during the initial public offering, they've decided they're going to raise capital by selling a portion of the company into the public at that time. And that could be 50%, 10%. They decide how much of that company they want to sell, in a sense, to the public on the stock market. That amount of shares that the board decides to authorize is called, strangely enough, authorized shares. So the board of directors will create something called the authorized shares. They may say we're going to start with 100 million shares. That's what we're going to authorize at this particular point in time. A portion of authorized shares is then actually sold to investors, and that's either during the IPO or during subsequent sales in the stock market. And that portion is called issued shares. So that's the portion that is actually sold to investors. And that's again typically through an IPO, which is an initial public offering. It's the first time that a company is coming out into the public stock market and offering a portion of their shares to the public. Okay, so there's different types of shares: authorized shares, issued shares. The next thing to talk about is treasury stock. Treasury stock is a company can go back into the open stock market and buy back their own shares. And when they do that, they're called, those shares are now called treasury stock. So they're buyback by the corporation. And this is done mostly for things like employee stock options and employee stock bonus plans. So if a company wants to give employees some stock as incentive to retain them because they're high level employees, they're the best employees, they want to keep them, they want to give them some stock, the company can buy shares off the open market and then transfer those shares to those valued employees. And there's other incentives like that corporations have that they can do with stock. One of the more popular things that they do with this treasury stock is actually retire the stock. And then when they do that, they're actually then retiring those shares. They're taking those shares completely off the market. And the reason they do that is, if you go back to the previous video where I talk about supply and demand, let's say a company has 300 million shares outstanding. If they bought back 10 million of those shares as treasury stock and then retired them, now there's 290 million shares outstanding. So now all of a sudden the value of those remaining shares has gone up because the overall total market capitalization, and we'll talk about in a minute, the overall value of the company hasn't changed, but the number of shares has changed. So each share that is left over is now a little bit more valuable. So that's one way that companies can return value to their shareholders, is to retire stock in this manner. The next thing to talk about here is outstanding stock. Outstanding stock is simply issued stock minus treasury stock. So equals issued minus treasury stock. And that's just a result of the fact that you have these different definitions of issued and treasury. And outstanding stock is what investors and analysts in the industry focus on when they're looking at a company. What is the total number of outstanding shares that are out there for a particular company? And it is what is used to calculate market capitalization, or market cap, that I mentioned earlier. So market cap is simply what the stock market views as the value of the company in simple dollars and cents. And so that would be outstanding stock times the market price per share, the market price of a stock. So if a company has, let's say, 100 million outstanding shares and each share was $10 a share, then the total market capitalization for that company would be $1 billion. And that's how they calculate that market cap. When you go ahead and own a piece of a company, when you're a shareholder in a company, you do have certain rights. And so let's get a new page for that. So shareholder rights. Pardon my scratching there, but you get the point. Shareholder rights. And there's several of those. The first one is votes. You can vote as a shareholder. You have the ability to vote on certain important topics that come up at the company's annual meeting. Every company that's publicly traded on a stock market has an annual meeting, and things come up for vote, and you can vote by proxy. So that means that the company will send you either something in the mail, or nowadays more likely via electronic method, either on their website or through email. They'll send you a ballot, and that will include several things like election of board members. So shareholders have a say into who is on the board of directors of a particular company. I should mention the board of directors is an independent, usually an independent group of people that oversee the corporation at a very high level in order to ensure that the shareholders' interests are maintained during the running of the corporation. So if you know, a company typically is run by people inside that are running the business, doing things, and there's managers and there's supervisors, and then there's VPs, and there may be several layers of management in between, and eventually there's a CEO that runs the whole operation. He or she is in charge of the whole company, and that person is not there, by himself or herself running everything without any oversight. That person is overseen by the board of directors. So the board of directors is very important in that sense, and shareholders have the right to elect the members of the board. So that's one thing you can vote on. The other things are things like major direction changes or major initiatives that the company plans to take. Major initiatives in the company. And other things that come up for vote are things like stock splits. And simply put, stock splits could happen in a company. Let's say typically what happens is a company stock price, if it's doing well, it's going up, and let's say it goes from $50 to $100 to $200 a share, and a corporation at that point may decide because in the past this was more relevant than now, but let's say the price feels too high for the typical average investor. They'd have to spend a lot of money to buy just 100 shares. So they may decide, let's split the stock. And in that case, what happens is you go from $200 a share to $100 a share, but the number of shares doubles. So you see you got the same value. Now you've split it, meaning you've doubled the number of shares that are outstanding, but you've halved the price, making it more attractive on the market for that share to be bought. That's like an old school way of thinking of these things, because nowadays you can buy less than 100 shares. And in some cases, you can even buy fractional shares, so it's not that important anymore. So fewer and fewer companies are doing splits these days, but that is possible. And that is one thing that you as a shareholder can vote on stock splits. There's also voting on issuing new shares. So if the board of directors decides we'd like to issue new shares to raise more money to be able to do things inside the company like grow or invest in new technologies or R&D or what have you, they would bring that issuing of new shares item to the voters, and the voters will decide whether that goes forward or not. And transfer of ownership is another one, another right that you have. And of course, that means you can sell your shares on the stock market at any time. You don't have to hold on forever if you don't want to. And you have the right to receive dividends, right? So if a company declares dividends, then you will be, of course, given the dividend as a shareholder. And now a dividend is when a company board of directors, with the approval of the shareholders, decides we're going to share profits with our shareholders by providing them a cash payment. And that's typically a percentage like 2, 4, 5%. Usually no more than that, unless it's a utility, which pays a little bit more in dividends. So they'll pay, let's say 2% of the value of the share as cash to the investor as part of a profit sharing plan, because the investors should reap the rewards of the company, and so they've decided to do that. There can also be stock dividends. So a company can provide dividends in the form of stock from treasury stock that I mentioned earlier, but typically it's more along the lines of cash dividends. And dividends are usually provided by companies that are more what they call value companies, that are not typically growing. If a company is growing every year or every quarter, they're typically not going to pay out dividends, because they're going to want to use that cash to fund and fuel their growth. and hire more employees, buy more equipment, expand in the offices that they need to expand to. So rather than paying out their profits as dividends, they're going to retain those and use them to fuel growth. A more established company that's already grown to the size that it's about to grow to, it's already very large, will then start to pay these cash dividends because they want to reward the shareholders with a portion of the profits. So there's another right that you have as a shareholder is called preemptive right. It's a preemptive right. And this just means that if the company decides to issue more shares, you as a current shareholder have the right to buy the proportional amount of shares that you own. So in other words, you get first crack at any new shares as opposed to new investors that will buy the shares if you don't. So for example, if you own 1,000 shares of a company and the company says, well, we're going to issue 10% more shares. So, if they have 300 million shares outstanding, we're going to issue another 30 million, that's 10%. If they do that, then you as a current shareholder have the option to increase your stake by 10% because that's what they're issuing. They're issuing an additional 10%. So that means you can buy 100 shares directly from the company before they put those shares out on the stock market. So that's a right that you have. And then the final right is more of what happens if the company goes under. If the company goes under, then common stock shareholders have what's called a junior claim to assets. So that means that you will be last on the list of any money that comes out after the company goes through bankruptcy and assets are all sold and cash comes in, and for all those assets, you will have a junior claim to the assets, meaning that first they'll pay the IRS and they'll pay employee wages and outstanding debts and loans to banks, and even preferred shareholders will get paid and bonds will get paid first. And then if there's any money left over, common stockholders will get paid. And usually that comes out to, if you get anything, you'll get like a fraction of what those shares were worth on the market before the company went into these troubles. So those are shareholder rights. And here I'll divert a little bit into talking about ADRs. These are ADRs, or American Depositary American Depositary Receipts. And these are these special instruments that are created by banks, commercial banks, where they establish a relationship with a foreign company and create these things called ADRs. And ADRs enables investors to buy shares of a foreign company on U.S. stock markets. And they're able to do that in U.S. dollars, okay? And that's a really good way for U.S. investors or investors that are typically investing in companies or buying and selling and trading stock on a U.S. exchange to be able to participate in the success of foreign stocks. So if you think about companies like Nestle or BMW or some of these Chinese companies that are out there, they typically have something called an American Depositary Receipt, which is established by a bank, which allows you to trade in those stocks on the U.S. markets. If those foreign companies do pay dividends, they're going to pay them to the bank in their currency. So BMW will pay their dividends in euros to the bank that's holding those ADRs, and the bank will then translate those or convert those into US dollars and then subsequently pay those US dollars to American investors that are holding the ADRs. The thing to know about there is that involves currency risk, currency exchange risk for those dividends. So what that means is that if there's a big fluctuation in between the dollar and the euro, or for one quarter to the next, then your actual dollar payment may be substantially affected by the fact that the exchange rates have fluctuated, and you may end up getting less. So sometimes you may end up benefiting from exchange rates It all depends on the fluctuation of those currency exchange rates on the currency market. There's other types of stock out there as well that we won't go into because we don't really have time, but things like restricted stocks and employee stock plans are out there that don't come up to in general for general public, so we'll stick to common stocks for the rest of the discussion. Stocks are traded on stock exchanges, and today they're mostly electronically traded. So today the most common, the most popular exchanges, especially for Americans, would be the New York Stock Exchange and the NASDAQ. The New York Stock Exchange is the oldest, and it's also tied together with other markets around the world. New York Stock Exchange, not many people know this, but has affiliations with other markets all around the world. So it's really a global market. And it is typically, in the US portion, it's open from 9:30 a.m. to 4 p.m. And the securities that are listed on the New York Stock Exchange are called listed securities. And the New York Stock Exchange is referred to as the first market. The OTC is the other important market. It's called OTC. So we have New York Stock Exchange, and then OTC. And OTC is a huge market. New York Stock Exchange is the first market. And OTC is called, guess what? The second market. And this is a huge electronic market. It's global. It runs 24/7, unlike the New York Stock Exchange. And the major trading that goes on the OTC is really all around bonds, treasuries, all the U.S. bonds, U.S. treasuries trade there. So it's a huge market going on all the time with people exchanging these debt instruments. I'm not going to talk about these in this video. I'll have another video talking about debt instruments like bonds and treasuries in the future. But just know that the OTC, that's the majority of what goes on in the OTC. But there's another important aspect of the OTC that relates to this video, which is the NASDAQ. You may have heard of that market. That's another stock market, another major stock market in the United States, where lots of our well-known technology companies trade. So things like Microsoft and Tesla and Google and all these companies that you've heard of trade on the NASDAQ. A lot of these tech companies are heavily traded there. And the NASDAQ has similar hours to the New York Stock Exchange, but it also has extended hours. So normal plus extended hours. So in the NASDAQ, you can actually trade some of the stocks as early as 6 a.m. and as late as 8 p.m. as opposed to the NYSE, which has a more tight trading window as far as time goes. The way you actually go about trading stock is you go to a broker online. Typically today would be an online broker dealer is what they're called, and these are stock brokerage companies. You know, they've got names like Vanguard and TD Ameritrade. And by the way, TD Ameritrade has been in the process of merging with Schwab, so that's another one that you may run into. And Fidelity is another one. There's many more, but those are kind of the big names in the game. And you would go onto their site and open an account. You basically just say, find their website, say a new customer, open an account, give them the information they're looking for. They're going to ask for your name, your address, your age, your social security number, address, a bunch of personal information. You provide all of that. You may want to link your bank account to them, or you may want to just send them a check, whichever way you like it, you can do it. And once they've approved your account opening and you've transferred money over to them, either by electronic transfer or by check, then you're ready to go. Now your brokerage account is funded and you're ready to trade stocks. You can go ahead and start. And the mechanics of that is pretty simple. When you go in, let's say you're going to buy your first stock, they're going to have an interface on their website or on an app on your phone where you're going to just enter the symbol for the stock. So let's say you're buying Microsoft stock, you just simply enter the symbol, which is MSFT, and you can find the symbol for these companies on their own website, on the brokerage firm's website, or on Google. And you sort of enter the symbol, and then you enter the number of shares you want to buy. Let's say you want to buy 50 shares. And then there's an options for whether you want to set a price or not. We'll talk about that in a minute or two, but that's as simple as that. Then you hit execute or submit button, and they'll go off and execute that order. And then within a few minutes, you'll have 50 shares of Microsoft in your account. Simple as that. Now, remember, I'm not saying you should go off and do that. This is just an example. You don't have to go off and buy any shares after reviewing this video, any shares of anything. So the broker dealers, these companies that we're talking about, interact with the marketplace, and they may have their own what are called market makers on the market, or they may interact with other market makers that make a market in every stock. So think of it as they're a middleman. Every single stock, like a Microsoft, a Google, Tesla, or what have you, has something called a market maker that sits in front of the market and literally makes a market for that particular stock. And what that means is that they are the ones that intermediate between buyers and sellers, or they can actually sell from their own what they call inventory of stock. So a market maker in Microsoft stock might already own 10 million shares or so. And when you go off and say, I want to buy 50 shares of Microsoft, they may sell it directly from their own inventory to you, or they may look for a seller that's already in the market wanting to sell. Remember, they have visibility over the whole market. So if they see one person over here wants to buy, another person over here wants to sell, and the prices line up, they can just join those orders together and boom, now you have a trade. Or they can sell from their own inventory if they choose to do that. The way the mechanics of that work is that every stock quote has a bid price and an ask price. So these are prices that are quoted. So every market maker will quote that, and you'll see the bid and ask in your interface for your brokerage account. And the bid is always lower than the ask. Okay, so this is the low price, and this is the high price. So let's say a stock, call it ABC stock, is trading at around $10. Well, the bid might be $9.50. And the ask might be $10, okay? And what that means is that the only way that you're going to be able to sell the stock is if you sell it at $9.50. That's how the market maker makes money. They're going to want to sell at the low end, and they're going to want you to buy at the high end. So they're going to make, as you can see, that difference of 50 cents on that particular trade. Multiply that by millions of trades that they do every day, and you can see it is very profitable to be a market maker, very profitable to be a broker dealer in stock markets. But that's how it works. So if, like I said again, if you are a seller of the stock, you're not going to get the high ask price. You're going to get the lower bid price. If you're a buyer, you're going to have to buy at the high end, and that's just how it works. There's no getting around it. And again, like I said, the broker dealer makes the difference on every trade, and this difference is called the spread. So that we're clear on that terminology you may have heard before, or maybe this is the first time. That's called the spread. Besides that spread, broker dealers can also make money on what's called a commission. And they could charge, a dollar amount per trade. It used to be $4.99 per trade, then it kept going down to $2, and then it went down to free. And years ago, when I started trading stocks, it was greater than $20 sometimes, the commission. So $20 per transaction per trade. So that was pretty expensive. So you didn't think about buying 5 shares of something that was $1 a share, because your commission was crazy compared to what you're actually spending on that particular stock. You thought about buying more in larger blocks of stock. But nowadays they're very competitive on price and on the commission side, so they may go down all the way to free. But remember, if it's free, it's not really free, because they're getting paid somehow. They're gonna make money on the spread. Maybe the spread will be a little higher, and so if they're making 50 cents, 75 cents per trade times millions of trades, they're going to be making a ton of money anyway. So nothing's ever really free there. But it is, of course, better to pay no commission versus paying $20 a commission, or somewhere in between. Also, I want to point out here that there are, of course, apps these days out there that allow you to buy small fractions of shares for very small investors who don't have maybe the cash to put out, $10,000 to buy 10 shares or 100 shares of a particular stock. Maybe you have $20, $30 that you want to start little by little. And so there's these companies out there that provide these apps that allow you to do that micro investing and things of that nature. Typically what happens there is that you're being charged very high commissions on those trades. So it's probably best for you to save up. And my advice would be for you to save up so you can be able to buy at least a full share or 10 shares of a particular stock rather than buying fractional shares from these apps, because in the long run it's more expensive to do that. But again, that's something that you'd have to decide between you and your personal financial advisor, and you should not take my information, which is general information, as personal advice directly to you. Now, there are some different types of orders I alluded to earlier. There's different types of orders when dealing with stocks, when buying or selling stocks, or which is called trading. When I say trading, I mean you could be either buying or selling, so you know that. So trading equals buying or selling. Okay, and so the different types of orders that you can enter when you go into your interface for your brokerage firm's website. The most simple order is called the market order. So if I say buy 100 shares ABC stock at market, that means that the broker, as soon as I hit the submit button, as soon as I hit that button, he's going to take the order and buy the stock, take money out of my account and buy the stock on the next market price. So, there's prices are changing all of the time, right? So the stock could be at 59.60, and then the next tick could be 59.70, and then it could be 59.40. And then if I enter right here, the market order to buy, on the very next tick, whatever the price is, that's what I'll get. Let's say I got 59.50. That's what I'll get on the very next tick after you click submit. Very simple way to submit an order to buy a stock. So it works the same way if you're going to sell market, you're going to get the next available price, and it's going to be the fastest execution. So if you want to get in or out of a stock the fastest way possible, it would be through a market order. Now, the risk of a market order is that the stock could change, the price could change dramatically from one tick to the next. Typically, that doesn't happen unless the stock is very thinly traded, if it's got very few shares outstanding. And in that case, you want to be careful of buying a stock that has very few shares outstanding, because you want to be able to have a very liquid market in which to either buy or sell the stock from. If you have a stock that you're buying that's very thinly traded, has very few shares outstanding, it may be difficult for you to just sell it later and offload it if you need to. So that is something to be wary of, is something that's thinly traded. If you see a very broad spread in a stock, like rather than being a few cents or maybe a quarter, 50 cents at the most, if you see like a dollar spread between bid and ask price, or even, I would be worried about even 75 cents spread between bid and ask, that means that stock is not broadly traded, it's thinly traded. Very few shares are being traded versus other stocks that might have a spread of 2 cents or 1 cent. So be careful with those too, because that means there's not a big market in those. And when it comes time to sell, you may have trouble selling at a price you want. You may have to sell at a lower price in order to get down to that bid price and offload that stock. So that's a risk of market orders. But I think I like market orders because it's immediate. As soon as you want to buy, you buy. As soon as you want to sell, you sell. You're not waiting around for some price to trigger, which is the next order that we'll talk about. So the next type is called a limit order. And this type of order is used when you want to avoid that issue with market orders, which means I get the next price. I'm not sure what it's going to be, but I'm going to get the next price. So if you don't like that and you say, no, I think I want a specific price, then you would put like a buy limit. Let's say if stock is trading at 55 and you want to buy a little, if the stock drops a little bit, so you'd say buy limit 54, then the order will stay there live but not execute until the price drops to 54. So if the price then from there goes up 55, 60, 65, and it never comes back to 54, you didn't buy the stock, you missed out. So in that case, you wish you would have done a market order. If the stock then does go from 55 down to 55 and 54 and a half down to 54, then it will execute and you'll get the stock at 54. That's as simple as that. And it works the same way on the sell side. You can sell limit, setting a price where your stock will sell if it hits that price. If it doesn't hit that price, it won't sell. You'll keep it. The next type of order is a stop order. And by the way, I should mention that limit orders are visible on the market, and they have to be visible because market makers have to be able to see that you're bidding 54 for a stock that's currently at 55. So that means that they may decide, well, you know what, I'll take it. I'll go down to 54 and give this person and sell this person the stock at 54. So those orders are visible. Stop orders are not visible because they are conditional limit orders essentially. So a stop order is, you're basically saying only make this a live order if the price gets to a certain, if the stock price gets to a certain number. And so let's say you have a stock that you bought at $100 a share. So you previously bought XYZ and you own it at $100 per share. And you want to protect yourself against a large loss, okay? You don't want the stock to get to 50 and then you've lost half your money. So let's say you're willing to take a 10% hit on that at most. And so you would put in a stop, sell stop at 90. And that would be if the stock dropped 10% or from $100 to $90, then you're going to sell there. And this sell stop, again, not visible to the market makers, becomes, if the stock, once the stock hits 90, it becomes a market order. Market order once it hits that price that you determined. So that means it hits 90, you'll get the next best price after that. So maybe 89.9, maybe if it's a little bit of an uptick, 90.1, you might get that. All right, so that's how you protect yourself when you're holding a stock against a major drop. So if the stock goes from 100 to 90, at least you know you're going to get 90. If it keeps going south to 50, 40, 30, whatever, at least you didn't lose all your money. You lost just 10%, which is a good thing. And as you might have guessed, there's a way to combine these things. You can have a stop limit order. So let's talk about that. So stop limit order means for, again, the stock that's you bought it at 100 and you want to protect from going too far down and you want to get rid of it. If it drops about 10%, you would enter a stop 90, limit 90.5, say. And in this example, if the stock fell to 90, you would trigger, the broker would then trigger a limit order of selling at 90.5. Trigger limit order. And in that case, the stock would have to drop to 90 and then tick back up to 90 and a half. And if it did, then your limit order would trigger and then you would sell your stock. Now, if it went to 90 and just kept going south in this example, you would never sell. And so you're open now still to be all those losses. So stop limit orders are sometimes a little dangerous in that way, but they give you that extra granularity in control. So, you know, if I had my way, I would use a sell stop and not so much a stop limit, or even a market order to get out if I'm thinking that the stock isn't going to do well and I'm not going to be around to see what happens. I might say, let's get out with a 7% loss or so and move on, right? So that's how these limit orders work. Now, I talked about selling here, but it also works on the buy side as well. You can do buy stops if, for example, you want to buy a stock, but only if you think it's only if you see it going up. And there's momentum investors do this. I'm not saying it's a good thing or a bad thing. I'm saying it's done, where they only buy a stock if there's a trend upward. And so they'll say, if a stock is trading at $80, they'll say, okay, buy stop 85, because they want to see this momentum. They want to make sure the stock is going up as they buy, as opposed to going down as they buy. It is better to buy in that direction, but whether or not it's a good thing to do these things, it's up to you and your personal advisor to determine. And again, also there's stop limits on the buy side as well. So that's how these orders work. I hesitate to talk about this next topic, which is called a short sale, but that is something that is out there that you may have heard of, so I'll describe it here so that you know what it is when people talk about short sales. Simply put, what a short sale is selling stock that you do not own. Believe it or not, you can do that. Selling stock, and I'm not saying you should, but you can. Selling stock you don't own. And the way that works is by essentially borrowing the shares. You borrow the shares from the market maker, and you then say, okay, market maker, let me borrow 100 shares of, let's say 100 shares of LMN stock, and sell it. Let's just say sell it at market price. And let's say that market price is $10 a share. $10 a share. And so now you've sold 100 shares for $10 a share, and actually $1,000 is actually deposited into your account. Believe it or not. You didn't have the shares. They weren't yours. They were the market makers. They belonged to the brokerage firm. And they're held by somebody else, probably some other stockholder is holding those shares, either the market maker herself or maybe even some other shareholder of the company. You didn't own them, you sold them on the market, and you actually just got $1,000 into your account. Now, that comes with some responsibilities and some repercussions. You are now essentially borrowing that money from the brokerage firm. So you're going to be charged interest, daily interest, and it's going to be pretty substantial. So the longer you do this without closing this transaction or closing this trade, the more interest will be charged to you. Okay. The other thing is the commission for this is probably higher than the standard commission for a trade. So it'll be a little more costly probably to do this short trade than it would be to just buy a stock. Okay, that's two repercussions. And the most important one is that, of course, you're promising to buy it back. You have sold short, meaning you're short the shares. You have to buy these shares back at some point in order to make the transaction whole. And so you promise to buy back. That's a big one. You have to do that. If you don't, you could get into serious trouble. And of course, the whole purpose of selling short, if it's going to work out for you, is that you're betting that the stock is going to go down. So let's say if it was trading at $10 a share, you're hoping that it goes down 9, 8, 7, 5, whatever it is. And let's say it goes down to $5 a share. So now LMN is at $5 a share. And you decide, oh, okay, that's good enough profit for me. I made 50%, basically, roughly speaking. I'm going to buy back the shares. So, and the trade there is called buy to cover. So you'd buy to cover the short 100 shares, again at market. So you'll get 100 shares at $5. And in this case, now you've bought, so you're actually putting money back into the situation. You bought that cost you $500. So the 1,000 that you got, out of that you paid 500, and you have 500 left over. That's your profit on this short sale and buy cover transaction. That's what short sellers wish would happen every time they did a short sale. Of course, your profit is, again, not 500. You're going to subtract from that. commissions, which are higher than normal commissions because you did a short sale, and you're going to subtract from that whatever interest they charged you for having borrowed that money for whatever amount of time. Sometimes short sales could be on the same day, sometimes they could take a few days, sometimes they could take a few weeks. The longer that takes, the more this interest is going to be on that money you borrow. So that's what people hope would happen on a short sale. A lot of times what happens is it goes against you and you lose money. So what happens is you sold those 100 shares at $10, and let's say that goes to $20 per share. Let's say LMN is now at $20 per share. In that case, it's time, because now the shares didn't go down like you thought, they went up, and you still have to buy to cover. So you might as well buy now, because if it goes to 40, it's even worse, right? It gets worse and worse and worse as the stock price goes up. So if you cover now, you'd buy the stock at, again, 20 times 100, which is 2,000. So now you've bought 2,000. You've paid $2,000 to buy it back. Subtract the 1,000 that you got, because you did get 1,000 when you sold it short, but you come to a loss of $1,000. So you see how that can really work against you. One loss of 1,000 plus the interest plus the commission fees, right? So it's 1,000 plus is what you've lost. So needless to say, selling short is very, very risky and not recommended by most, and really takes a very sophisticated investor to do it. And I just put it on here as an educational purpose to see what happens. Theoretically, selling short is unlimited loss potential, right? You could have a stock that just goes crazy and goes to the moon, as they say, as the young kids say, and goes to $1,000, $10,000 per share, and you're liable for all that difference. But whatever is the difference between the price that you sold short at to the price that it ends up at, that's what you have to pay. So you could be liable for unlimited amount of downside there. So again, very, very risky, not for the faint of heart. So stock investing can be profitable, but it can also be very risky. And I just want to warn everyone against those pitfalls, especially new and young people going out and doing some investing. It could lead to the loss of everything that you've invested. And in the case of shorts and other esoteric things that are out there that cause you to be exposed to unlimited risk, you could end up losing even more than what you had invested. So I caution you to learn as much as possible about these things and to really get educated before you go out there and start doing any kind of investing. I actually do not recommend investing in individual stocks, and I don't do that myself typically. What I typically do is invest in index funds, and there's very good reasons for that. I'll go into that in future videos, but suffice to say for this one that I want to just give the information, let you know why these things are hard, these things are difficult. Sometimes they can be profitable, sometimes they could lead to losses, and even major losses. So, it's more of a beware and a cautionary tale for you to learn. This is, again, something that I wish I'd known earlier on in life, because I did a lot of trading of individual stocks in my early life, and I thought, I can figure this stuff out. I'm smarter than the average bear. And I hit on some, but I missed on a lot of them. And in the end, my results were not great. And I found out much later in life that investing in index funds for the long term, as opposed to individual stocks for the short term, was much, much better. Again, I'll cover that topic of index funds in a future episode, but just, I just want to give everybody that heads up. Beware if you do start to dip a toe into the stock markets, that there's a lot to learn and there's a lot of pitfalls to avoid. Anyway, I hope this was helpful. Thanks for watching and have a great day.